Good morning everyone. Today, we will explain the material about cash flow and balance sheet. Do you know what is cash flow and balance sheet? If you want to know, let's watch and following this video. Before that, we will introduce ourselves. My name is Safril Padang, you can call me Safril. And
My name is Rezyndiva Dantik Kurniawan. You can call me Diva, Rezyn, or whatever you want.
so, this is the video. Okay, I will explain the first material that is cash flow statement. Cash flow statement. Cash flow financial statements are reports that report cash receipts, cash disbursement, and net cash changes originating from operating, investing and funding activities during the period reported. In the financial statements of cash flow both in goods and services companies, there are three parts, namely, first, cash operating activities. Example of cash operating activities are payments and income from accounts receivable, salary payments, operational expenses, and so on. Cash reports from operating activities consist of main activities or operations in a company which directly impact on cash. Second, cash investment activities is a financial cash report relating to the acquisition of sales and purchases of fixed assets or permanent assets. Third, cash funding activities. Financial statements of cash flow related to owner investment, borrowing funds, and withdrawing money by the owner. In general, or both direct methods and indirect methods, there are five steps that can be used as a way of preparing cash flow financial statement. Namely, 1. Calculate the increase or decrease that occurs in cash. 2. Calculate and report net cash used in operating activities using the direct methods or indirect methods. 3. Calculate and report net cash used in investment activities. 4. Calculate and report the net cash used by funding activities. 5. Calculate the flow and add net cash from the combined net cash used by operating, investing and funding activities with the initial balance of cash, or as proof of similarity with the final cash balance. Okay, for the next material will be explained by my friend Rezyndiva Kurniawan. Thank you.
Balance sheet. Balance sheet is one part of the financial statement of a business entity or company in which there is information about assets, liabilities, and equity of shareholders at the end of the accounting period of the company. The report will later become the basic for a business company in making business decisions. There are three important elements in the balance sheet, namely assets, liabilities, and equity. First, assets. Assets are debt owned by a business entity that are expected to provide business benefits in the future. Assets can be divided into two types, namely 1. Currently assets. Currently assets are assets with a useful life for the short term. The process of disbursing this current asset is less than or a maximum of 1 year. Some of which are included in current assets are cash, receivable, equipment, stock, and prepaid expenses. 2. Fixed assets. Fixed assets are assets with a useful life for a long period of time, more than a year. These assets are generally used for the company's operational interests. Some of which are included in fixed assets are soil, building, machine, and equipment. This type of asset experience depreciation due to usage and reduced lifetime. In addition, fixed assets also have other forms, namely intangible fixed assets. Some of which include intangible fixed assets are patent, copyright, trademarks, rental rights. Then liability. Liability is a payment obligation that must be carried out by a business entity or to another party, both in the long term and in the short term. Some included in the liability are debt, prepaid income, and accrual or costs that will be due. Liabilities or obligation can be divided into two, namely, first, long-term debt. Long-term debt is any debt whose payment period is relatively long, some of which include long-term debt including bond debt, mortgage debt, and others. Second-term debt is all debt that must be paid in a relatively long time, no later than 1 year. Some of those included in short-term debt include debt vessel or vessel pay, trade debt, and cost to be paid. And the last is capital or equity. Capital is money or goods used as a basis for doing a job. In this case, the capital in the balance sheet is the balance of the final capital of a company in one accounting period. In other words, capital or equity is the difference or more value of asset reduced by liability. So, equity is asset minus liability. Thank you.
That's the video from us. If there are errors and deficiencies in this video, we apologize. We hope this video can be useful for all of us. And don't forget to like, comment, and subscribe to our channel. Thank you for your attention and see you next time.